Have you ever wondered why some investors spend hours researching individual companies, while others simply buy one fund and let it grow for decades? Even more interesting, why does one of the world's greatest investors, Warren Buffett, recommend that most people invest in an S&P 500 index fund instead of picking individual stocks? The answer might surprise you. Many beginners believe investing is about finding the next Apple, Amazon, or Nvidia before everyone else. Social media is filled with stories of people turning a few $1,000s into millions by buying the right stock at the right time. But what those videos rarely show are the thousands of investors who lost money trying to do the exact same thing. Here's the truth. The smartest investors aren't always chasing the biggest returns. They're building systems that help them grow wealth consistently while controlling risk. And that's where the debate between ETFs and individual stocks begins. By the end of this video, you'll understand exactly how both investments work, the advantages and disadvantages of each, why professional investors often combine them, and which option makes the most sense depending on your goals. Let's start with the basics. A stock represents ownership in a single company. When you buy one share of Apple, you're buying a tiny piece of Apple. If the company grows, earns more profits, launches successful products, and investors remain optimistic, the stock price can increase. If the business struggles, faces competition, or misses expectations, the stock can decline. Owning individual stocks means your investment depends heavily on the success of specific companies. Imagine you invest $1,000 into one company. If that company doubles in value, your investment becomes $2,000. But if the company loses half its value, your investment falls to $500. That's both the opportunity and the risk. Now let's talk about ETFs. ETF stands for Exchange Traded Fund. Instead of buying one company, an ETF allows you to buy a collection of investments in a single purchase. Think of it like this. Buying one stock is like betting on a single athlete to win a championship. Buying an ETF is like owning an entire team. If one player has a bad game, the rest of the team can still perform well. For example, one of the most popular ETFs tracks the S&P 500, an index of roughly 500 of the largest publicly traded companies in the United States. When you buy an S&P 500 ETF, you're gaining exposure to companies across technology, healthcare, finance, consumer goods, industrials, and more. Instead of depending on one company, your investment is spread across hundreds. This is called diversification. Diversification is one of the most powerful concepts in investing. Imagine owning only one restaurant in a city. If business slows down, your income suffers immediately. Now imagine owning small pieces of hundreds of businesses across different industries. Some may struggle, but others may thrive, helping balance your overall returns. That's exactly what diversification does. Professional investors know they can't predict every winner. Instead of trying to be right every single time, they reduce the impact of being wrong. This simple idea has helped millions of investors build wealth over decades. So why do some investors still buy individual stocks? Because individual stocks offer something fiat ETFs usually cannot: the potential to outperform the market. If you invested in Amazon years before it became one of the world's largest companies, your returns would have dramatically exceeded the overall market. The same was true for Apple, Microsoft, Nvidia, and many other successful businesses. But there's another side to that story. For every company that becomes a massive winner, countless others never reach their potential. Some businesses lose market share. Some fail to innovate. Some disappear entirely. That's why picking winning stocks consistently is much harder than it appears. Professional fund managers with research teams, advanced software, and years of experience often struggle to outperform broad market indexes over long periods. If professionals have difficulty doing it consistently, imagine how challenging it is for the average investor with limited time. This doesn't mean stock investing is a bad idea. It simply means it requires more knowledge, research, patience, and emotional discipline. Now let's compare risk. Suppose you invest $10,000 in one company's stock. If unexpected news causes the stock to drop 40%, your investment immediately falls to $6,000. Now imagine investing that same $10,000 into a diversified ETF containing hundreds of companies. One company performing poorly has a much smaller impact because the other holdings continue contributing to the portfolio. That's why ETFs generally experience lower company-specific risk. Notice something important. Lower risk doesn't mean no risk. ETFs can still decline during recessions, bear markets, financial crises, or periods of economic uncertainty. If the overall market falls, many ETFs will fall with it. The difference is that you're not relying on the success or failure of just one business. Now let's discuss another important factor many beginners overlook: time. Successful stock investing requires continuous research. You need to understand financial statements, earnings reports, competitive advantages, industry trends, management quality, valuation, cash flow, debt levels, and future growth prospects. That's a significant commitment. An ETF, on the other hand, is often much simpler. Many long-term investors choose diversified ETFs because they allow them to spend less time analyzing companies and more time staying invested. Instead of asking, "Which stock should I buy next?" they ask, "How consistently can I keep investing over the next 20 years?" That shift in thinking changes everything. The biggest advantage in investing isn't predicting tomorrow's hottest stock. It's remaining invested long enough for compound growth to work in your favor. And that's where many smart investors gain their biggest edge. One of the biggest questions investors ask is simple: which one actually makes more money over time, ETFs or individual stocks? The honest answer is that it depends. If you pick one of the world's greatest companies early, an individual stock can outperform almost any ETF. Companies like Apple, Microsoft, Amazon, and Nvidia have delivered extraordinary long-term returns for investors who bought early and held through years of growth. But here's the problem. No one knows today which company will become the next long-term winner. For every stock that becomes a success story, many others underperform the market or even disappear entirely. That's why relying on a single company can be risky. Broad market ETFs work differently. Instead of trying to predict the next winner, they own many of the winners automatically. As companies grow and become larger parts of the market, they naturally become larger holdings inside many index ETFs. At the same time, companies that decline gradually represent a smaller portion of the fund. This automatic adjustment is one reason index investing has become so popular. Now let's talk about costs. When you buy an individual stock, many brokers today charge no commission for standard US stock trades. However, you still need to spend time researching companies, monitoring earnings, and deciding when to buy or sell. ETFs usually charge an annual expense ratio. For many broad index ETFs, that fee is very low, often just a few hundredths of a percent each year. While the fee slightly reduces returns, many investors consider it worthwhile because they receive instant diversification and professional index management. Next comes taxes. Taxes vary depending on your country, account type, and personal situation. So it's important to understand the rules that apply to you or consult a qualified tax professional. In general, long-term investing often results in fewer taxable events than frequent trading. Investors who constantly buy and sell individual stocks may create more taxable transactions, while long-term buy-and-hold strategies can be more tax-efficient in many situations. Now let's discuss dividends. Some companies share part of their profits with shareholders through regular dividend payments. When you own a dividend-paying stock, you receive dividends only from that company. Dividend ETFs are different. They hold many dividend-paying companies. So instead of relying on one business to continue paying dividends, your income comes from multiple companies across different industries. For investors seeking more consistent dividend income, diversified dividend ETFs can reduce the impact if one company cuts or suspends its dividend. Let's talk about emotions. This is where many investors lose money. Imagine one of your stocks drops 25% in a week. Fear takes over. You start wondering whether you made a mistake. Then panic selling begins. The opposite also happens. A stock rises quickly, excitement takes over, and investors buy after prices have already surged. Successful investing requires controlling emotions, and that's often easier with diversified ETFs because your portfolio is less dependent on the daily movement of a single company. Now let's answer the most important question. What do smart investors actually choose? Many experienced investors don't see this as an either-or decision. Instead, they combine both. A common strategy is to build the foundation of a portfolio with diversified ETFs, then allocate a smaller portion to carefully selected individual stocks. For example, someone might keep most of their portfolio in a broad U.S. market ETF while using a smaller percentage for companies they have researched and strongly believe in. This approach aims to balance stability with the opportunity for higher returns. Before you decide what to buy, ask yourself 3 simple questions. How much time am I willing to spend researching investments? Can I stay calm when markets become volatile? Am I investing for the next 6 months or the next 20 years? Your answers matter more than trying to find the perfect investment. For many beginners, broad market ETFs provide a simple way to start investing while learning how markets work. As experience grows, some investors gradually add individual stocks to complement their diversified portfolio. The key lesson is this: building wealth is rarely about finding one perfect investment. It's about investing consistently, managing risk, staying patient, and allowing compounding to work over many years. The investors who succeed aren't usually the ones chasing every market headline. They're the ones following a disciplined plan through both good markets and bad. If today's video helped you better understand the difference between ETFs and stocks, make sure to like the video, subscribe to the channel, and share it with someone who wants to become a smarter investor. Thanks for watching, and I'll see you in the next video.